Welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is titled Tax Developments in Hong Kong and Singapore. This is the first webcast in our new financial services tax series. We look forward to sharing with you on a range of financial services tax topics over the coming months. My name is Michael Belton and I'm a financial services tax partner based in Singapore. I have 6 speakers with me today. Jonathan Culver, Jessica Chu, Junwei Han, Richard McKenda, Kevin Ng, and Roy Fan. Jonathan is an international tax partner with Deloitte Hong Kong and is our Hong Kong financial services tax leader. Junwei is a financial services senior manager with Deloitte Singapore. Richard, an indirect tax partner with Deloitte Singapore and the Deloitte Asia Pacific indirect tax leader. Kevin is a financial services tax manager in Singapore. Jessica, financial services senior consultant with Deloitte Hong Kong, and Roy is an international tax partner based in Hong Kong. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Now let me give you an overview of the topics we'll discuss. Broadly, the theme for our presentation today is the Hong Kong and Singapore budgets, and we will start with a recap. But what we really want to do today is take some of the key updates, some of the key changes, and really unpack those a little bit and discuss those in more detail. So what we'll be doing, we'll start with a recap of the budgets, both Hong Kong and Singapore. Then we'll focus on Pillar 2 and the domestic minimum tax that have been announced. From there, we'll look at some investment management related updates and the Singapore carbon tax and broader ESG initiatives and what that means. And finally, we'll be looking at some of the GST changes, not only those announced in the budget, but also those that will take effect on 1 January 2023, with a view to discussing, planning for those and sort of really understanding what's required over the coming months. But first, we'll start with a recap of the Hong Kong and Singapore budgets. So if we can move to the next slide. And with that, I'd like to bring Jessica Chu in to talk about, just to recap on the Hong Kong budget. Jessica?
Thank you, Michael. In the Hong Kong budget announced last month, there were a few key tax changes that are worth taking note. There was the announcement that Hong Kong will implement a domestic minimum tax regime. And there were also a number of incentives introduced to support Hong Kong in light of the COVID situation, and also to reaffirm Hong Kong as a global financial center. As one of the first in Asia Pacific, Hong Kong has announced the introduction of a domestic minimum tax regime. A domestic minimum tax regime essentially mirrors the OECD's Pillar 2 rules and allows Hong Kong to collect tax that would otherwise be collected in other jurisdictions. This regime is set to roll out in 2024. Now onto the tax incentives. Hong Kong will provide tax concessions to the investment holding vehicles that are managed by a family office in Hong Kong. There will also be a 50% tax concession for the maritime and port sector, bringing down their tax rate to 8.25%. Continuing from the tax incentives from last year, there will be a 100% reduction in profit tax, up to $10,000 of tax benefit. And finally, there were multiple proposals to internationalize the RMB currency. For example, allowing mainland investors to trade and settle their stocks on the Hong Kong southbound trading platform in RMB with stamp duty exemptions. So now back to you, Michael, to share the Singapore budget.
Thank you, Jessica. And in terms of Hong Kong, we will pick up on Pillar 2, and particularly the impact on the incentives, including those that were announced. But in terms of Singapore, interesting budget, focus on, spending, redistribution, but equally a recognition that, there are revenue challenges and there is a need to sort of, to quote our Finance Minister, Minister Lawrence Wong, to build a fairer and more resilient tax system. So we did see some kind of key tax changes in the budget. Like Hong Kong, we announced our response to the Pillar 2 Globe rules, and that we will also introduce a domestic minimum tax. The mooted GST increase from 7 to 9% will take place in two steps, an increase from 7% to 8% on 1 January 2023, and an increase from 8 to 9% on 1 January 2024. As I mentioned, there's some other changes taking effect on 1 January 2023, and we'll pick up on those. The other, another change was the increase in the carbon tax that was announced to $25 per tonne in 24 and 25, rising to $45, and in due course, up to $80 by 2030. Importantly, and this is the point that we'll pick up, today. Importantly, was the announcement that for business, they can actually use high-quality international carbon credits to offset up to 5% of their taxable emissions in lieu of paying the carbon tax. So we'll pick up and talk a little bit more about that later in the webcast. And finally, as you would expect, there were some specific tax proposals relevant to financial services, including an extension to the scope of designated investments for the fund management, resident fund schemes, non-resident sort of managed fund schemes, including an expansion, sort of the range of investment precious metals that can be invested in and qualify as a designated investment. So kind of key changes. And as I said, this webcast is all about sort of unpacking the key ones of, the key changes and understanding them a little bit more, but also importantly, understanding the implications for business as we start to move forward in 23 and into 24. Next slide, please. So with that, we'd like to move to Pillar 2. As Jessica mentioned, as I mentioned, both Hong Kong and Singapore announced their response to Pillar 2, the introduction of a domestic minimum tax. So let's start with that. Both have announced it. But first and foremost, I think it's important to sort of explore what a domestic minimum tax is, and from there we can sort of unpack that further. But importantly, how does that fit within Pillar 2, and what are some of the kind of the key design issues? Junwei, if I could bring you in here, maybe if you could sort of share your thoughts around sort of what a domestic minimum tax is, just to kind of get us started on Pillar 2.
Yeah, thanks, Michael. So both Singapore and Hong Kong have announced a domestic minimum tax, and this is a reaction to the Pillar 2 developments that were led by the OECD. Now, what is a domestic minimum tax, and what is it intended to do? Well, a domestic minimum tax, or for short, let's call it a DMT, is basically intended to preserve each country's taxing rights over the entities within its territory. And we have an example here on the screen to illustrate this. So as most would know by now, Pillar 2 basically introduces a global minimum tax of 15%, and it affects multinational enterprises with group revenue of at least 750 million euros. Now, the main rule under Pillar 2 is known as the income inclusion rule. And what the income inclusion rule does is to allow the jurisdiction of the ultimate parent entity in a group to impose a top-up tax on any low-tax jurisdiction held within the group, or rather entities in a low-tax jurisdiction held within the group. So in this example, we see a UPE in country X, and it's holding a subsidiary in, say, Singapore or Hong Kong. So let's assume Singapore with a tax rate of 17% for corporates. And after running through the usual tax computation processes, you claim sort of tax exemptions or capital allowances. Ultimately, we find ourselves paying $10 in taxes on an income of $100. So from a Pillar 2 perspective, the ETR will be viewed to be 10%. And under Pillar 2, the income inclusion rule would allow country X as a jurisdiction of the UPE or the ultimate parent to impose a top-up tax with respect to the difference between the minimum tax of 15% and the current ETR of 10%. So the difference in 5% under the income inclusion rule is picked up by the jurisdiction of the UPE. Now, from the perspective of Singapore or Hong Kong, the question would be, why would you want to allow another jurisdiction to pick up the tax? And therefore, what a DMT would do is to basically allow such a jurisdiction to impose the Pillar 2 top-up tax within the country itself. So in this case, say Singapore will be imposing a top-up tax to push up the effective tax rate or the ATR from 10% to 15%, leaving country X with no remaining right to impose any top-up tax vis-a-vis the Singapore subsidiary. So Michael, back to you.
Thanks, Junwei. I mean, before kind of looking at some more specific issues related to the domestic minimum tax, maybe if we could just take a slight step back. I mean, the budgets for both locations were back in February. I mean, Jonathan, perhaps to start with you, what's the process from here in terms of in Hong Kong implementing the domestic minimum tax? I mean, perhaps if you could describe that. But I guess also, is there going to be an engagement process? Can impacted domestic businesses sort of input into that process? But basically, Jonathan, where are things at and where are they going in terms of the implementation of the domestic minimum tax?
Sure, Michael. Thanks for that. I mean, it's been a long time coming. I would say. I think this process started probably a year and a half ago, when the FSDC first submitted some recommendations to the government in terms of the way forward, and the government subsequently set up an advisory panel in order to prepare for Globe in general. I think, frankly, for that whole period of time, it's been fairly evident that a domestic minimum tax was the way forward for Hong Kong. And so that government panel that's been set up for the last year or so, that's tried to look at some of the larger, more macro issues around the DMT, for example, including whether a DMT should be applicable just to those inbound, but also to those Hong Kong headquartered companies as well, and whether there should be any kind of staggered implementation. Now, in terms of the way forward, the budget announcement makes clear that a DMT is the direction that we're going. So that's more or less confirmed now. And the process from here in is, one of firstly consultation and then legislation, and that should happen across the next 6 to 9 months or so, subject to any reactions to the ECOFIN developments. Now, the government has been fairly busy doing some private consulting, via the FSTB and the IRD. They've met with the various chambers of commerce. They've also met with, various different industry bodies and privately with some of the largest organizations in Hong Kong as well. So they've collected a fair amount of feedback. And of course, we've been helping with that process as well. And of course, we've been having, dialogue directly with the government bodies as well. So a few different ways they're collecting feedback, and, they will do so in a more public way in the near future before legislating.
Thanks, Jonathan. Junwei, in terms of Singapore, I know in the budget it was flagged that there was going to be working group, etc., established. But where are things at the moment in Singapore?
Yeah, thanks, Michael. So I think similar to Hong Kong, it's a process of consultation moving to legislation. So as announced in the budget, we are in a consultation process. So the IRAS is having private consultations, and frankly, they're very interested to hear, what the advisor community thinks, what multinationals think about Pillar 2, and in particular, various points within specific sectors that would be painful for different types of MNCs. So I would say that this is ongoing. It's very active. Things are moving very quickly. And if you are part of a multinational group that do not have existing discussions or conversations with the Singapore authorities on Pillar 2 or the DMT, feel free to reach out, and we'll be happy to work with you to voice out any concerns.
And Junwei, on the technical aspects, I mean, there's an engagement. Sorry, there's a working group, that has been convened. Yeah.
Yes. So I mean, I think from a Singapore perspective, what we want to do is to make sure that the domestic minimum tax in Singapore is aligned with Pillar 2, obviously, and it's a qualifying DMT from a Pillar 2 perspective, yet at the same time taking into account with any sort of peculiarities or domestic concerns in Singapore. I mean, simple examples would be in Singapore, we may have a more unique rules on the taxation of financial assets that may not we may not find in some jurisdictions, and just making sure that insofar as Singapore has more unique taxing rules, that our design of the DMT will take into account as to whether, to what extent can we as closely align our domestic minimum tax with our domestic tax rules so that we reduce the compliance burden on taxpayers.
Yeah, great. Thanks, Han. Next slide, please. I mean, if you think about Singapore and Singapore's economic development, sort of going all the way back to 1965, tax incentives have been kind of a key tool in terms of driving, attracting investment to Singapore. More recently, we've seen incentives in Hong Kong, the Corporate Treasury Centre incentive. Jessica described, the proposals in the Hong Kong budget back in February. One question that's coming up in the context of both locations is, what does this mean for incentives? Jonathan, your thoughts on that?
Yeah, it's, as you say, Michael, very good question, very common question. I suppose when people ask this question with the globe and the DMT in mind, they think, well, is this effectively going to override my incentive? And in some cases, that is absolutely the case. And the global DMT could make sure that incentives are of little practical use, right? And could really constrain the ability of both jurisdictions to make effective fiscal policy. In other cases, that won't be the case at all. Okay, so for example, let's say you've invested heavily in one of the jurisdictions. You have a lot of highly paid employees. You might have significant assets, but perhaps some very expensive premises. The substance-based income exclusion is something that's relevant from a globe and a DMT perspective, and that could give you a very significant carve-out of the profits that are subject to globe, right? So after you apply that exclusion, you may find that the top-up tax could significantly reduce. If we stay a bit closer to the financial services sector, we think about treasury arrangements. Both jurisdictions have treasury incentives. One of the hallmarks of a treasury centre, it tends to have fairly thin margins, and in some cases, there'll be withholding tax on some of the gross interest flows that are received. If that interest withholding tax, and any interest withholding tax on those payments, if that's reflected in the accounts, that will be treated as a covered tax. That covered tax could, significantly offset any negative implications from top-up tax around the Treasury Centre, and it might even be blended further into the rest of the group in either jurisdiction. And so, in that scenario as well, it could be the case that top-up tax wouldn't necessarily bite in the way we might think it normally would. When we come to the banking sector, we look at hedging arrangements. Hong Kong, Singapore are both jurisdictions which are used for market access products and other hedging arrangements. Now, withholding tax is not always accounted for in those arrangements, but we've explored with a number of clients ways to allow that withholding tax to be accounted for through the financial statements. Indeed, then it could be considered a covered tax, and it could significantly reduce the top-up tax that might be due. So, those are just a few examples, and there's certainly plenty of other ways which we've been exploring to kind of, mitigate some of the unintended impacts of globe or some of the most onerous impacts. And so, you can only really do those if you continue to have an incentive, you continue to take advantage of those preferential tax regimes, and then you can, mitigate the consequences of something like globe. But without those domestic tax regimes or exemptions, that's really difficult to do. So I guess, that would be my reflections on this, Michael.
No, great, thanks, John. So you would expect Hong Kong to continue to offer incentives, be that for Pillar 2 impacted groups or obviously non-Pillar 2 impacted groups?
I think they will. You might see them, revisit, look to adjust these slightly, but I don't think it will change the landscape too much.
Okay. Han, in terms of Singapore, as I mentioned in posing the question to Jonathan, obviously, broad range of incentives in Singapore, both in the financial services sector and elsewhere. So, I mean, how do you see, the continued offering of incentives in Singapore? Are there particular kind of considerations that the various agencies are focused on with respect to incentives?
Thanks, Michael. Yeah, so I think, as mentioned earlier, the concern is the negation of tax incentives due to the top-up under Pillar 2. So, but at the same time, I think the government has made clear that they're not going to scrape the entire, playbook of incentives, because there will be groups that nevertheless benefit from tax incentives, even though there is, the Pillar 2 rules out there. Say, for example, if you are excluded, or for example, if group revenue does not cross the threshold of 750 million euros. So with that in mind, tax incentives will remain. There will, as Jonathan mentioned earlier, we do think that they are planning opportunities. But also in terms of the government's perspective, in terms of incentivizing continued investment in Singapore, I think everybody's expecting an expansion of the toolkit, perhaps an increased focus on government grants and other kinds of support beyond a reduction in tax rates.
Thanks, Han. Perhaps if we could move to the next slide, and Han, maybe if you could pick up a little bit more on that point around non-tax incentives.
Yeah. Also, actually, maybe we could go back to the previous slide first. Yeah. I think one question about talking about the future of incentives ties in with these rules that we're discussing, the DMT and the income inclusion rules, and basically the Pillar 2 rules. And the OECD has been very concerned or very watchful as to whether jurisdictions will look to collect taxes on one hand and basically redistribute the monies as grants on the other hand. So in terms of the model rules, the Pillar 2 model rules, the relevant rules do include language that would prohibit such practices. Basically, in order for, say, a DMT to be qualifying, governments cannot be providing benefits to taxpayers that are related to taxes collected under the DMTs. So there has to be a disconnect between any provision of government grants and the collection of taxes under, say, a DMT. So that break has to be there. But otherwise, I think the interest continues to be in how to, say, use grants or other non-sort of tax rate incentives to continue to incentivize investments. Back to you, Michael or Jonathan.
Thanks. No, thanks, Han. Appreciate that. Perhaps if we could move to the next slide. So I guess, Jonathan, bringing you back in, there's a question around timing, right? I mean, Pillar 2 was income inclusion was supposed to start 1 January 2023. What's the status on that? What's the current thinking on that?
Yeah. So I think most people will have seen some of the headlines across the last couple of weeks. There was an ECOFIN meeting, which is a European finance minister meeting. And of course, the topic was Globe, right? And during that meeting, they didn't reach consensus, right? They didn't reach consensus around the timing of implementation. There were some concerns around whether they had ability to legislate quickly enough. There are also some concerns that if they went ahead and legislated, this year, that Pillar 1 might be, effectively never come into effect because the Americans, might not feel leveraged to introduce Pillar 1 because, they always wanted Pillar 2, and they will have effectively got that if Europe goes ahead. So the Europeans suggested that they would delay for about 1 year. So they suggest they'll implement on 31st of December 2023. So still within 2023, but effectively 1 year later. So that delay by the Europeans effectively gives the rest of the world, political capital to also delay the implementation of Globe. And so, while it's not something that's been announced yet, I would anticipate that lots of jurisdictions are going to take this opportunity to delay as well and to give themselves a bit more time. Now when it comes to DMTs, I think there's a question as to to whether Hong Kong and Singapore will delay, because of course they're scheduled at 2024 at the moment, and so I think really the question is, did they schedule for 2024 in order to give themselves a little bit more breathing room, or did they plan to implement the DMT in 2024 for other slightly more complex reasons relating to the delay of UTPR versus IAR, which is something that could really be favourable to Hong Kong and Singapore headquartered jurisdiction companies. We don't have time to go into that right now, but it's something we can discuss offline with anyone who's interested. So, Michael, back to yourself.
Thanks, Jonathan. Next slide. Han, bringing you back in, and I know this is a complex issue as well, but perhaps some thoughts on how the DMTs will interact with CFC rules, and thinking about jurisdictions like Australia, which has CFC rules. So, any thoughts around that?
Yeah, thanks, Michael. So this is pretty complex, but I'll try to summarize some of the key points. And I think this is particularly relevant for groups that they have a current thinking that they will not be adversely impacted by Pillar 2 beyond having additional compliance burden. Because one key focus now, one key discussion point now is the interaction between DMTs and CFC rules. And I think if this is not resolved properly, we may see instances of double taxation. So let me explain. As we discussed in the start of this section, we said that DMTs have a greater right to tax than income inclusion rules, right? So if two countries have those rules, one with DMT, one with the income inclusion rule, the country with the DMT has the primary right to tax. But if you follow the GLOBE or the Pillar 2 model rules, a country with a CFC rule, according to the GLOBE computation methodology, has the greatest right to tax. And if you follow what I view to be the Pillar 2 design of how the GLOBE income and top-up tax is meant to be computed, the CFC rules have the greatest right to tax. So I think when you see some countries thinking about implementing DMTs in order to basically collect tax revenues that would go to UP jurisdictions with income inclusion rules, we may see sort of a pushback where, for example, UP jurisdictions might be tempted to introduce or broaden CFC rules, right, to capture revenues that would otherwise be lost to DMTs. So say in country X, in this case, remember that country X had an income inclusion rule, but it couldn't collect any taxes because in the low tax jurisdiction, say Singapore, Hong Kong, such a jurisdiction imposed the DMT. Now, in the event that country X implemented or broadened its CFC rules and imposed a CFC tax on amounts with respect to the subsidiary in, say, Singapore, Hong Kong, then under the GLOBE model rules, I think in principle, it would have the right to tax. So number one, we may see UP jurisdictions seeking to expand CFC rules. You might be tempted to do so. Number two, I think jurisdictions in the likes of Singapore and Hong Kong, in designing their DMTs, are likely considering whether the DMTs should ignore CFC taxation altogether. In other words, it will not allow CFC tax to be allocated to the local country for ETR purposes, such that the domestic top-up tax would apply regardless of how much CFC tax has been imposed. If so, what this means is that we may see country X imposing a CFC tax on the same bucket of income that the likes of Hong Kong and Singapore might also tax in the form of a DMT. And the question there would then be whether we can, say, get a credit in the CFC jurisdiction for DMTs imposed on that bucket of income. And if the issue of credibility cannot be resolved, which is ultimately a question of who gets the taxing rights, then we may see double taxation arise. Michael, back to you.
Yeah, thanks, Han. And just to finish out this segment, Jonathan, Han's just spoken about, interaction with CFC rules, but more fundamentally, in terms of a DMT interacting with existing domestic tax law and taking Hong Kong as an example, are there any sort of points you'd just like to highlight there in closing?
Yeah, I think, frankly, there are a lot of areas where a DMT could, interact with local domestic law. And obviously, we don't have time to really cover them. One example that just jumps out is, in the funds exemption area. So generally, Hong Kong's unified fund exemption is relatively similar to the globe rules in terms of their fund exemption. But actually, in the case of Hong Kong, we also have an anti-avoidance rule, which can deem an investor to be subject to tax on the profits of the otherwise exempt fund, where investors in Hong Kong hold 30% or more of a fund's value. That isn't present in the globe rules, and so there'll be a big question for Hong Kong: should it relax the anti-avoidance rule to be consistent with the globe rules, and thereby make itself slightly more attractive as an international financial centre? So that remains to be seen, but just one point of overlay and interaction that we should be looking out for.
Great. Thanks, Jonathan. And Han, thank you so much for your comments on Pillar 2. Maybe sort of staying with the funds theme, investment management theme, and moving to the next segment. Can we go to the next slide, please? Next slide. Jessica mentioned in the context of Hong Kong, new concession for family offices, and we do want to look at that in a minute. But I guess just wanting to make the broader point that investment management as a sector remains very important to both Singapore and Hong Kong. Just looking at the more recent stats, Singapore 962 registered and licensed fund managers, AUM of 3.5 trillion US, Hong Kong 1,878 asset managers, and AUM of 4.1 million trillion. And obviously in both locations, we've seen a lot of developments, particularly over the past few years, to kind of really continue to enhance the development of both sectors. The sectors in both locations. Hong Kong and Singapore, we've seen the launch of onshore vehicles. In Singapore, the Variable Capital Company, or the VCC. Hong Kong, the OFC, as well as more recently, the Limited Partnership Vehicle. Both locations, we've seen growth in family offices. In Singapore, that's been particularly stark. We now have over 200 family offices managing 20 billion US assets, and that's underpinned by our resident fund exemption schemes. And Hong Kong, again, more recently, the enactment of the exemption regime for carried interests. Next slide, please. And it's not, obviously not just tax developments or the new vehicles. Broader regulatory developments, broader initiatives. Sort of the ASEAN kind of collective investment scheme, the ASEAN passport. Philippines has joined. There's looking to sort of broaden that. Singapore, we've recently established a fund industry group, to review regulatory and tax policies to enhance, the environment for fund management. Regulatory, focus on climate risk in particular, sustainability, and we'll touch on that as well. And Hong Kong, similar type broader development. So both, Hong Kong and Singapore, investment management's kind of key, right? Next slide. But I guess there's a couple of issues we wanted to sort of pick up and just update around. And Roy Fan, bringing you in. So both Hong Kong and Singapore, have onshore sort of corporate, vehicle, the VCC and the OFC. Can you just kind of just briefly recap around, these vehicles, and then perhaps, we can pick up and talk a little bit more around sort of the use we're seeing of these vehicles and really kind of sort of try to gauge their success as we move forward. Roy?
Sure. Thank you, Michael. So on a very high level, both VCC and OFC are onshore fund vehicle in corporate form with variable capital features that could facilitate investor coming in and out from time to time. Sub-funds can be set up in the form of a segregated portfolio within the same VCC or OFC. Both VCC and OFC are required to be managed by a licensed fund manager locally. From a tax perspective, there are fund exemption regimes both in Singapore and Hong Kong that could apply to VCC and OFC on specified income derived from designated investment or qualifying assets. There's no withholding tax on dividend distributions by VCC or OFC. On indirect tax, Singapore levy GST and incentivized fund can claim GST recovery based on a fixed recovery rate, currently at 89%, while for Hong Kong, there's no indirect tax at all. And lastly, both VCC and OFC in corporate form are potentially accessible to the tax treaty networks of Singapore and Hong Kong, respectively. So this is kind of the high-level overview regarding VCC and OFC, Michael.
Yeah, thanks, Roy. Next slide, please. So I guess, Roy, the interesting kind of question is, what's the uptake been? What's the experience so far been, with the OFC? As I understand, it was a little bit slow, but things have picked up of late. So, perhaps can you sort of share, where the numbers are at, but importantly, sort of, what's the focus of these funds in terms of asset class or target investors or investment jurisdiction? So, just kind of keen to understand, where things are at, and also, what's kind of driving, the use of these vehicles.
Sure, Michael. So the OFC regime was first launched in late July 2018, which is around 3.5 years from now. When the regime was first launched, it wasn't that well received by the market, and the uptake was low in the first 2 years, to be honest. However, following the introduction of tax exemption on carry interest, which applies since 1st April 2021, fund managers are now more receptive to adopt an onshoreized fund structure, such as OFC, or more recently introduced Hong Kong limited partnership fund vehicles. Besides, the Hong Kong government launched a subsidy scheme in May 2021 for newly incorporated or established OFC, which is another push for the regime, in my view. With that, we have seen the number of newly set up OFC pick up quickly in the last 18 months, from less than or around 20 OFC to around 170 OFC as of today. Typically, OFC set up in Hong Kong are more for hedge fund instead of PE/VC funds, which are more used to limited partnership structure, and they would likely go for Hong Kong LPF for a onshore fund vehicle. However, we are starting to see PE fund structuring themselves as OFC to enjoy the subsidy on setup costs, as I mentioned, while at the same time still able to qualify for the fund exemption as well as the carry interest tax exemption in Hong Kong.
Thanks, Roy. In terms of the VCC, it was launched 19-20 January 2020, 400 plus vehicles as of October 21, which is when we stopped kind of publishing the numbers. A bunch of factors that have driven that sort of use. Clearly, the grant scheme has kind of really helped encourage that. But I think the broader point for both locations is having that onshore vehicle as part of the toolkit, the fund toolkit. Given sort of a bunch of the broader changes that have been happening, has proved to be timely, and I do think we'll see kind of continued use of the vehicles. In Singapore, it's being used across asset class. Increasingly, being used by sort of, regional and other, sort of fund sponsors, for all sorts of, different sort of funds, for different funds. But Roy, in terms of the budget, and one important part of investment management is wealth management, and within that, sort of, encouraging family offices, because it does kind of flow in to support private banking and other type activity in the location. Can you sort of, very briefly sort of update around sort of the concession that's been proposed for Hong Kong for family offices? And perhaps if we could move to the next slide at the same time.
Sure. Thank you, Michael. Well, actually, I think we have been waiting for over a year until this new concession comes out, because in the budget last year, the government already announced that they would review the tax regime for family office. And in this year's budget, in February, the government announced that there will be a tax concession on the single family office structure in Hong Kong. And more recently, the government actually issued a consultation paper regarding this new regime. So maybe let me go through the key features of the proposed tax exemption based on what being described in the consultation paper. So in the structure, you can see on the left-hand side, there is a family investment holding vehicle, what we call the FIHV, which is actually the SPV owned by the family for holding investments. And one criteria is that this FIHV should have its central management and control exercised in Hong Kong. Investment of FIHV managed by a single family office, what we call or referred to as SFO in the structure. And this single family office similarly requires its central management and control to be exercised in Hong Kong. So basically, all the issue shares, interests of FIHV and SFO must be exclusively and beneficially owned by individuals who are connected persons of the same family. SFO, the single family office, cannot provide investment management services to entities other than the FIHV within the same family. So profits tax exemption would apply to FIHV in respect of qualifying transactions and transaction incidental to the carrying out of qualifying transactions, subject to 5% threshold. It is expected that the definitions of qualifying transaction and incidental transaction will mirror those under the Unified Fund Exemption regime in Hong Kong, which basically include transactions in investments such as listed securities and private equities, subject to further conditions such as the 2-year holding period test for PE investments. Besides, for the exemption to apply, the aggregate average AUM of the FIHV shall be at least 240 million Hong Kong dollar, and there is a substantial activity requirement for the FIHV, which is currently proposed to be having at least two full-time employees in Hong Kong, with annual operating expenses of a minimum of Hong Kong dollar 2 million incurred in Hong Kong. Lastly, for eligible FIHV, they are required to make an irrevocable election for relying on the tax exemption under the new regime. So that's an overview regarding this new tax concession for single family offices. Back to you, Michael.
Great, thanks, Roy. Next slide, please. Perhaps just to kind of close out, this segment, just with a brief contrast to Singapore, the family office in Singapore is really supported by the existing resident fund exemption schemes, which are now being renumbered as 13O and 13U, previously 13R, 13X. There are substance, conditions, with respect to each of those. But the regime is, that Hong Kong's looking to put in place is an existing regime in Singapore to give certainty around tax treatment, in particular the taxation of trading gains. Next slide, please. In the Singapore budget, and perhaps moving a little bit specifically to Singapore, there was the announcement as to where the carbon tax is going to increase over time. Kevin, can I bring you in here just to talk a little bit about that development, but what that means, as I kind of alluded to earlier, in terms of the development of carbon credit trading markets in Singapore, or for Singapore rather. Kevin?
Thanks, Michael. So I think at this slide, I've attempted to summarize some of the recent developments in ESG initiatives from the recent COP26 to the Hong Kong and Singapore budget announcements. But perhaps what will be more interesting would be the next slide, where, as you mentioned, the Singapore Finance Minister announced a phased increase in carbon taxes from the current $5 per tonne up with a view of reaching $80 per tonne by 2030. The exact pace of increase will be announced subsequently. More importantly, from 2024, businesses will also be able to use high-quality international carbon credits to offset up to 5% of their taxable emissions in lieu of paying carbon taxes. So we have several reactions to this development, which are summarized in the next slides. First, there's the age-old definitional question. How will international carbon credits be defined? So will they only be limited to carbon credits which are sold on Climate Impact X, which is the newly launched SGX marketplace? Or will they also extend to cover more established carbon credits such as Verra's Verified Carbon Standard? Second, there are some questions about whether or not this would result in new products associated with such carbon credits or new fund strategies. So I think we have seen a lot of developments in this space. Just last week, some key developments include the launch of Hong Kong's first carbon futures ETF, the CICC Carbon Futures ETF, as well as Climate Impact X announcing a partnership with Carbon Place in order to provide a record of ownership and in order to facilitate the reliable, secure, and scalable trading of certified carbon credits. We can also see, or we have also received queries from funds who are starting to look towards backing green projects in order to harvest the carbon credits and trade them. So this would result in several interesting tax implications. So first, from a Singapore direct tax perspective, IRAS has also recently, 2 weeks ago, updated its website in order to explain or to confirm that the general income tax principles will also apply to the determination of the buying and selling of carbon credits. So from a buying perspective, companies that purchase carbon credits may claim a deduction if it fulfills the general deduction rules. In addition, IRAS has also issued a pseudo-administrative concession by recognizing that a company purchasing carbon credits in order to comply with its regulatory obligations will be regarded as having purchased the carbon credits for its business purposes and can therefore claim a deduction. Similarly, on the flip side, from a selling perspective, well, first, companies trading in carbon credits, any income arising from the trade of carbon credits will follow general tax principles as well. Similarly, and in order to mirror the pseudo concession for carbon credits, purchase of carbon credits, where a company sells these credits thereafter, the income derived will be considered part and parcel of the company's business income and hence taxable. Companies should also bear in mind the interaction between the buying and selling of these carbon credits with the newly enacted sections 10J and 32A of the Income Tax Act. So as a quick overview, these provisions deal with the tax treatment of trading stock which have been appropriated for non-trade or capital purposes and vice versa. So this would be relevant in situations where the funds, for example, choose to retire the carbon credits that it trades for its own ESG goals. From a Singapore indirect tax perspective, we also have the age-old question of characterization. How should carbon credits be characterized for Singapore GST purposes? Unfortunately, the answer to this is it depends. So, on one hand, the sale of carbon credits could be characterized as a derivative and therefore an exempt supply for Singapore GST purposes. On the other hand, it could be treated as a set of rights, and therefore any supply of the carbon credits is treated as a supply of services for Singapore GST purposes. If the carbon credits is a service, then the normal GST rules will apply. So to the extent that, for example, a GST registered entity sells the carbon credits, it will have to charge GST at the standard rate and will therefore be affected by the upcoming rate changes in 2023-2024. Offshore entities that supply the carbon credits to a Singapore entity will also have to consider the overseas vendor regime, which I believe Richard will be moving on to discuss. So, but first, back to you, Michael.
Thanks, Kevin. Next slide, please. And yes, as Kevin mentioned, our last segment today does relate to GST and the impact of the rate changes, but some of the other developments, some of the other requirements that will be in place for 1 January 2023. And with that, as I said, last but not least, Richard McKender, can I bring you in to sort of walk us through these changes, but also your thoughts on how business should be preparing for them over the course of this year? Richard?
Yeah, thanks, Michael, and good afternoon, everybody. So as you said earlier, Michael, then the GST rate is going to be increased over 2 steps. So one adjustment on 1 Jan 2023, and then a later adjustment on 1 Jan 2024. So that was well trailed in the budget, and has been explored a little in some detail on various kind of publications and in the media. There are other changes coming as well that you can see on the slide there. So it's going to make 1 Jan 2023 quite a significant date for GST purposes. So the overseas vendor registration rules, which we have in place at the moment and deal with digital services to non-GST registered consumers where supplied from outside Singapore to inside Singapore, is going to be expanded and will become a remote services rule. That remote services rule is going to require vendors who supply services where there is no immediate connection between the place of supply of the supplier and the place where the recipient is to register and charge and collect the GST. That is going to include advisory services, including sort of financial services as well. So it's a much broader definition and is going to have some implications, which we'll look at in a minute. Allied to that, we're also bringing in an amendment to the low-value goods rule, which will require suppliers who sell low-value goods below $400 by air or post to also charge, register, and collect. That has an implication for partly exempt businesses who are not able to recover all of their GST. They're going to have to start to monitor what they buy below $400, whereas before they have never thought about it. And finally, there's going to also 1 Jan 2023, there is going to be the removal of a concession for overseas broker charges, which has been in place for a very long time indeed. That concession was supposed to be taken away in 2022, but the local brokers pointed out that it required some fairly serious system changes and therefore was extended. So all of that is taking place on 1 Jan 2023. And if we can move to the next slide, then we can kind of explore a little bit further about what that means and about what we would suggest you need to be thinking about. So clearly from a rate change perspective, the big story is going to be in ERP systems and what you need to do from an ERP tax code table perspective or tax code hard coding perspective to make sure that you can charge and collect and report. But you mustn't forget, of course, invoice formats are going to need to be changed because invoice formats generally have a rate of GST on them at 7, and you're going to have to change it to 8 and then to 9. And obviously, that might be a system-generated invoice, or it might actually be paper-based that you just print. And therefore, you've got to think ahead about logistics, right? How do I change that? Do I need to order? And so on. You also need to start thinking about your pricing because, clearly GST is going up. And you have to charge more, but your input prices are going up as well. And if you're, partly exempt, then costs are going to be coming up, because you can't recover all the GST that you're incurring. On the other hand, then there is a committee for I forget the exact wording of it, but there's a committee in place for kind of anti-profiteering, right? So you're going to need to manage pricing between those two sort of rocks and hard places. And not get stuck in the middle. You also need to think about the transitional rules, right, and what they mean for you from a GST reporting perspective. So whether your supply is fully completed, billed and paid for before the date of the implementation and go live or after depends on how much GST you're charging at the old 7% rate, how much you're going to charge at the new 8% and 9% rate in due course. So you need to kind of work through that process and make sure, in particular, if it's a system-generated invoice, how it's going to work it out, or otherwise, what from your tax team's perspective, what they need to do to make sure it's done properly. Also, if you look at the remote services rules, and we look at the low-value goods rules, and we look at the broker change rules, then there's quite a lot there that's really more around process, right? So being able to understand what type of supply you are making from an overseas perspective into Singapore and be able to split it out into its taxable versus exempt pieces is going to be a fairly significant exercise. And we've already seen quite a lot of dialogue between some of the industry bodies and the Revenue Authority about how that might work in practice. Those dialogues, I suspect, will continue, but I think IRAS seems to be pretty sure that they want to do this, and will go ahead. So our recommendation is that you cannot leave this too late. It's a big IT change because IT owns your ERP system, and IT needs to be involved to make the changes. There are front office changes as well in terms of pricing and in terms of some of the front office systems that you also need to amend. And therefore, our recommendation is to get in front of IT and to start kind of modelling out these changes so you know what you're doing, and you don't get caught by a short time frame. We should also just highlight here, last point that I want to make is around post-implementation reviews. So we saw when reverse charge came in, the Revenue Authority putting in place some kind of post-implementation reviews and audits to check that things were being done correctly. We should expect that IRAS will do something similar here, particularly around the remote services rules and the low-value goods rules, which are going to fall on businesses to track, even though very few of you are going to be importing at less than $400 by air or post. You need to have a process in place and show that it works. So IRAS is going to be looking, I would suggest, on those points. So Michael, a very quick skim through the GST rules and back to you.
Great, thanks, Richard. Thank you, Jonathan, Junwei, Jessica, Richard, Kevin, Roy. That brings us to the end of our discussion today. But we do have a few minutes to respond to some questions from our audience. And Jonathan, maybe to bring you in. I mean, there's a couple of questions which I think kind of go to the same point. One is how will the tax authorities in Hong Kong and Singapore cope with administering DMTs, and what does this mean for companies operating in those locations? And I guess the related question was how should we be preparing for the Hong Kong and Singapore DMTs, and I guess kind of by extension Pillar 2 more generally. So Jonathan, just a couple of minutes, just sort of thoughts on those questions.
Sure. No, thanks, Michael. And of course, they're good questions. I think, firstly, that the tax authorities in both jurisdictions have been dealing with significant international tax change over the past few years, and are probably already stretched relatively thin because of that. The Pillar 2 rules themselves, 60-odd pages of rules, 230 pages of commentary, 50 pages of examples, and that's just what's kind of written there. There's actually lots of complexity and uncertainty, and there are many areas where interpretation is required. So I think it's clear that the tax authorities are going to struggle somewhat to get a team of people up to speed and really capable and competent in this space. Now that, frankly, I think makes them a little bit dangerous, right? Because, they might not fully understand the rules, how they're intended to work. And you might see some funny positions being adopted by them. What's the best way to respond to that? Well, I think it's to be well organized, well staffed, well resourced, and frankly, well advised as well. When it comes to preparing for Pillar 2 more broadly, it's really important that you have a consistent strategy throughout the organization. And that means above tax as well as below tax, right? So I think it's important to be aligned at the CFO and maybe even the CEO level if you're going to be significantly impacted. Really understand the priorities of those senior leaders, whether it be on compliance or mitigation, and then have an effective plan and a working group across the organization to try to implement Pillar 2 in a way which is consistent with those strategies, in a way which gives proper regard to how you'll source data and so on and so forth. So I think, they're my key very high level messages, Michael.
Great, thanks, Jonathan. And perhaps just one final question, and Han, if I can bring you in. Is a wealth tax still on the agenda for Singapore? Any quick thoughts on that question?
Yeah, thanks, Michael. So I think before the budget came out, there was a lot of discussion about wealth taxes in Singapore. And what we saw in the budget was not a net wealth tax, right? So they specifically singled out a net wealth tax and said Singapore will not implement a net wealth tax. And instead, Singapore increased the property tax rates. Now, the question then becomes whether Singapore will stop here or whether Singapore will continue to expand the range of different types of wealth taxes that it has to continue to build that more resilient tax system, right, and a more equitable society. And I think we will. I think the government has been consulting and thinking about wealth taxes for a long time. And I certainly personally believe that they will not stop simply at the property tax increase, but they'll be exploring, different options as well.
Thanks, Han. That unfortunately is all we have time for today. Thank you to my colleagues, Jonathan, Junwei, Jessica, Richard, Kevin, and Roy, and special thanks to all of you who were able to join us today. We would like to encourage you to fill out the short survey that has popped up or will pop up on your screen, and tell us what you thought about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the Share This icon and have them visit the Debriefs website. We will respond to all of your questions, to all of the questions submitted during the webcast within the next kind of week or two. Also, if you think of any other questions or comments later, please feel free to reach out directly to me or our other speakers. We'd be more than happy to talk to you. As I mentioned at the outset, this is the first of a new sort of financial services tax series. The next scheduled webcast in that series is on the 12th of April, and it's titled Financial Services Series Tax Developments in China. And at last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Thank you.